When people ask what drives rapid growth in wealth management, they're usually hoping for a single answer. One strategy, one breakthrough, something they can implement by next quarter. But here's what I've learned after years of studying high growth advisory firms. The ones achieving the most sustainable success aren't doing one revolutionary thing. They're doing hundreds of small things exceptionally well. And when you ask them about it, they're often reluctant to say that out loud because maybe they think it sounds less impressive than we built a revolutionary lead generation engine or we've disrupted the traditional model. But CJ Rendic, founder and CEO of Parallel Advisors, said it anyway. When I asked him why Parallel is growing so rapidly, he told me, people expect a silver bullet answer. It's this one thing that we're doing, Meg. And really, it's not. It's the hundreds of things that we do at Parallel. That honesty is what makes this conversation so valuable. CJ founded Parallel Advisors in 2006. It took 10 years to reach their first billion in assets. Then something shifted. Today, they manage over 10 billion. They've doubled in just 3 years. And that acceleration wasn't luck or perfect timing. It's what happens when you build systematically until you hit the inflection point. Today, I'm joined by CJ, along with Mike Murray, head of firm development, and Jake Schutt, chief wealth officer and head of family office at Parallel Advisors. Together, they're going to unpack exactly what those hundreds of things actually look like in practice. Growth Leaders podcast tells the stories of advisory firm founders driving differentiated growth. And what makes Parallel different isn't a dramatic innovation. It's operational excellence. It's creating capacity through internal book transitions. It's building advisor forums borrowed from the YPO concept. It's having honest conversations about what works and what doesn't. In this episode, you'll hear about strategies that failed, like their Bay Area lead generation pilot that generated plenty of leads, but none that could convert. You'll also learn about the 3 levers of growth that never all fire at the same time and why that's normal. You'll discover how Parallel gives advisors 2 paths to equity with the same economic outcome. And you'll hear CJ explain why they invest in advisor activation over corporate lead generation, even though that's sometimes the harder path. What I want you to listen for is the operational honesty, the patience, the hundreds of small decisions that compound over 20 years. Because this isn't a story about finding the secret. It's about doing the work. Let's get into it. CJ Rendic founded Parallel Advisors in 2006 after working as a consultant at Accenture and then as an advisor at UBS. Today, the firm manages over 10 billion with 60 advisors and 60 million in revenue. But here's what most growth stories skip over, the timeline. Because Parallel's path wasn't a steady climb. It was a decade of patient building followed by rapid acceleration. And that pattern isn't random. It reveals something fundamental about how sustainable growth actually works in wealth management. Let's hear from CJ on how they got here. So has the growth from 2006 when you launched the business to 2025, which is where we are recording this today at the end of 2025, has it just been consistent, steady growth over that period of time?
No, it has not. In fact, it took us about 9 years, 10 years to get our first billion in AUM. And like you mentioned, we're a little bit over 10 billion. So we've, so that was sort of the first growth phase is keeping the blinders on and, basically getting to that first billion, which was our mission initially. And then there's sort of a second phase where, we grew from $1 billion and brought on a capital partner to try and help us, accelerate growth there. So we actually went from 1 billion to where we are today in, roughly another 9-10 years. And I'd say that the last couple of years, growth has accelerated because we brought on a capital partner. Golden Gate Capital is our private equity sponsor. And with some of that capital injection, we were able to build additional parts of the business. We were able to enhance our recruiting packages, get involved in M&A. So we've almost doubled in size since we partnered with them about 3 years ago.
Golden Gate made the investment in 2023. And what was your AUM then?
So it was a little bit over 5 billion. I think it was about 5.5 billion.
5 billion. And at what point in 2023? What month?
It was actually the end of 2022. We closed, I think it was December 30th. So
you've doubled in 3 years, essentially. Doubling from 5 billion in AUM to 10 billion in 3 years. That kind of acceleration doesn't happen by accident. It requires both the infrastructure you've built and the capital to leverage it. But here's what makes CJ's explanation valuable. He's not going to give you a neat formula where everything fires at once. What he's about to describe is how growth actually compounds when you build multiple engines and accept that they won't all peak simultaneously.
Yeah, you know what's interesting, and we talk a lot about this at our board meetings and internally as a team, is these 3 levers of growth. We have the organic, inorganic, and market, basically. What's interesting to me is they never all fire, all 3 cylinders typically don't fire every year. And we'll have 1 or 2 that kind of, win the day. Now, we have consistently been growing at over 20%, but one year it might be more market driven. The next year it might be, recruiting driven, and there's a lot more advisors that are joining us. Other years we get phenomenal organic growth. We land some big clients. So every year doesn't look exactly the same. But those are definitely the 3 channels that we're trying to drive. And there's some, call it, maybe counter correlated, inversely correlated factors between those 3 that cause them not to all hit in the same year. But, if you look at this year, we're over 20% growth. And it's a lot of market driven, performance this year versus the recruiting or the organic. Last year, it was more of the recruiting, that drove it, although the market was good as well. So I don't know if that's, sort of a crisp answer to your question, but I wish it was consistent every year. It's definitely not easy to do, but if we keep focusing on these 3 channels, eventually we'll get 1 or 2 that work, every year.
This validates what every founder experiences, but rarely hears acknowledged. Not every lever of growth fires at the same time or yields the same results year to year. You build multiple engines and you capitalize on whichever one is working. That acceptance that you don't need all 3 levers firing simultaneously is what separates patient, systematic growth from the constant chase for the next big thing. So let's unpack these 3 levers, starting with organic growth, because this is where most firms actually make their money and where Parallel's approach to advisor activation reveals something important about capacity and infrastructure. Jake Schutt is the Chief Wealth Officer and Head of Family Office at Parallel. As one of the firm's original co-founders, he has one of the most comprehensive perspectives on how this firm has been built. Jake came up as an advisor himself, ran the technology, ran investments, ran a family office book. Today, his role as Chief Wealth Officer puts him squarely focused on enabling advisor growth. Here's how he thinks about it.
Growth is always an important part of any advisory firm. And so it's an important thing that we spend a lot of time on in collaboration with the advisors at the firm. There's a number of things that we do, everything from some training programs that we have in place. And those are focused on the types of work that advisors do to provide great advice to clients. And so that's everything from complicated intergenerational wealth transfer plans to stock option strategies or in-depth planning and how you approach the planning exercise in order to service the client well over the life of that client engagement. One of the key levers of growth for us over the years, in my opinion, has always been our commitment to planning. Because planning does so much to build a lot of trust with the clients, number one. Importantly, we learn everything there is to know about the client in that process, and so we can make better recommendations to them. Sometimes it's obviously investments, but also other parts of their life, which are equally important. And then we use the plan going forward as a yardstick to not only see how we're doing relative to the goals, but also make sure that the client remembers why we're doing the things we're doing. And obviously, as everybody knows, you can use planning engines to run scenarios. And so that's a super helpful way to educate clients on the decisions that they have in front of them. And so we bring the plan up every single time we get in front of a client and talk to them about it. And when I was running a big book of clients, I would get referrals from new prospects before they even signed paperwork to join the firm. And so planning for us has always been core to what we do. And that's one avenue that advisors continue to grow and expand their relationships with their client base. I think the other things are also equally important, and that's obviously getting out in your network and telling the story in a consistent way and interacting with a diverse group of end target prospects. And I know we've talked about this in the past, but it's important for advisors to know what types of clients they find most appealing to work with and can service those types of clients really well. And as an advisor myself, that niche wasn't apparent to me in the beginning, but I sort of came to that realization later on. And so every advisor comes up with their own niches and the things that they're interested in and the circles that they run in. And so you sort of fall into it naturally. And so helping advisors think through what those niches are and to be deliberate in the approaches that they take to foster those types of prospects is another element of what we do, both in the way that we run our little forum groups, which we'll talk about more, but also just in the day-to-day approach to finding other avenues to get out there and tell the story. And so there are more avenues here as well that we use. We think that creating your own success requires you to have a lot of activity. And so we have a system inside the firm where you can track your activity, and then your activity leads to prospects, which ultimately leads to clients. And you can quickly figure out how many more times do I have to go tell the story to get a certain amount of assets in the door. And so it sort of gamifies it in a way that's kind of fun. I know that I do this on the family office side, and unfortunately my ratio is actually fairly high. Trying to close large families like this with multi-generational and lots of complexity is a little harder than what I used to do in the advisor role. But nevertheless, I have a number. And so now I can go out there and tell the story, and I just have to tell the story a certain number more times and I'm getting another client in the door. And so it sort of demystifies and takes the pressure off of a little bit, makes it a little bit more fun. And when you have a peer group that's doing the same thing, you can commiserate and trade stories and learn from each other in that process.
When a firm like Parallel is so invested in advisor growth, how do they think about capacity? Because in order to really drive repeatable advisor growth, capacity has to be the unlock. Capacity otherwise is the constraint that kills organic growth at most firms. Advisors cap out, growth stalls, and firms either lower their service standards or have to turn away a segment of business. Parallel built something different. They created an internal mechanism that solves both the capacity problem and the succession problem simultaneously. And the economic structure they use, this is where it gets interesting, actually aligns everyone's incentives. The senior advisor monetizing clients, the junior advisor acquiring them, and the firm there to ensure continuity. So let's dig into how this actually works.
So capacity is always an issue at all growing firms. It's sort of the bane of your existence. The faster you grow, the more capacity issues you have. And it touches every aspect of the firm. From an advisor standpoint, as you become more successful, you have more clients, you have to figure out a way to manage the workload. And there's two ways to do it. There's sort of what I would call a fairly simple way, which is that as you continue to grow, you routinely carve off a part of your book of business. And at Parallel, we have a framework to make that happen where you can transition any number of clients to another advisor. And so that advisor might be newer in his career or her career and have capacity to take on those clients. And so that's a transaction that happens where the advisor that is transitioning those clients out gets paid for those clients, and the advisor that's taking on those clients will have a lower revenue share over time in order for that transaction to occur. And then everybody's still aligned to want to make those clients successful in that framework, right? Because if I'm the advisor that's transitioning them, because of the transition schedule of the payment, the more successful those clients are as they've moved on to the other advisor, the more I get paid over time, right? So there's alignment of interest there to make sure that the clients are taken care of and that it's a smooth transition for everybody. And yet the newer advisor is obviously getting a new group of clients. They're able to expand their own skill sets and grow those clients up and continue to get referrals from those clients. So that's what I would say is a relatively straightforward approach. I would also point out that you don't have to give everything to one advisor. You could divvy up your book to multiple advisors. So if you have a cohort that would fit better with one type of advisor's approach, you can do that with them and take another cohort and give it to another advisor for that group of clients. So it's very flexible in that manner. I think the second thing that's hugely important is how advisors ultimately structure the resources on their teams to be able to handle the workload that continues to show up on as they get more clients in the door. And so that's everything from the junior advisor role right down to how they interact with operations and the workflows that occur there. And the more successful you get, the more junior advisors you have, the more staff that you're running. And so that's a big piece of what we pay attention to. And I think we will continuously pay attention to it. There's a lot of work we can do there. But there's frameworks for making that happen too. And they're not just one size fits all approaches for structuring teams to be able to handle more complex workflows for a larger number of clients. And then the last piece, which I think a lot of people don't talk about, especially when you have your advisor hat on, is all of the support on the back end at the firm, right? Whether it's operations, whether it's the data team, whether it's the finance team, there's a lot that has to happen in those roles in order to handle the capacity that's happening across all the advisors. And so we measure all of the time and effort that operations does on a daily basis, right down to the minute, so that we can keep track of when we need to hire another person in operations. And we have a unique operations structure, which I think we've talked about a little bit on the podcast already, but that also means that we have to have the same focus on the data side of the house, because bigger clients have more complex data needs that need to get consolidated and brought in and managed. And that's a whole nother issue, right? Alternative investments, right? Reporting and all that stuff. So there's a bunch of things that need to be paid attention to there on the capacity side. And then also on the finance side, right? On making sure that the billing's done correctly and the invoices are going out and the money's in the accounts to get feed on it. And so there's a follow-on effect that you really can't lose sight of, because if any one of those pieces slows down, then you've got a bottleneck issue, and so it slows the whole, sort of puts a spanner in the entire works. There are structures where you have a lot of junior people working for you, and that's the pathway. Training in that instance is obviously, we need to get people assimilated into the firm and they understand the click paths and the things that need to happen process-wise. But then there's also, how do I actually run that team of people? It's almost an HR issue, right? Like, how do I think about the frameworks for paying them, the bonus structures, who's running those teams of people for me if I don't want to do that, right? And so there's a framework in that first bucket that I think we can do a better job of communicating and systematizing. Another approach to teams is that, hey, as an advisor, I'm going to bring on a bunch of junior people to help me with my workflow and all the clients that I have. But my ultimate goal is to grow those people up and launch them as full advisors, right? So it's slightly different, but it with its own unique set of challenges, right? Because the minute I get a successful person launched, I suddenly have a capacity issue again, right? I need another one right in the background that's following along and learning from the others that are ahead of him or her. And so you can start to leverage the knowledge of the team itself inside the entire parallel structure. So I wouldn't say we've got this completely figured out, but I'd say we've got a couple frameworks that are working, and we just need to continue to fine tune them and make them better, more systematic in a way that it relieves some of the management of the team from the advisor. The advisor is always going to be in charge of their team, but can we put more infrastructure around them so that the playbook is easier to follow, right? Mm-hmm. And that's what we're focused on these days.
Let me circle back around to what Jake mentioned a few moments ago, the transaction that happens at Parallel where the senior advisor transitions clients to another advisor and gets paid for those clients, and the advisor that's taking on those clients gets a lower revenue share. I wanted to know if Parallel helps those advisors fund the transition.
Yeah, I mean, that's definitely one of the ways that we help create bandwidth is to help advisors who are very good at business development basically carve off pieces of their books and choose a successor. Typically, it's a shared, because we're on the revenue share model, and there's pros and cons to every different way that you compensate advisors. But ours is primarily a revenue share model. And so there is a sharing of that revenue for a period of time until, the sort of the selling advisor, stops getting that revenue share, and then the successor advisor gets the full revenue share over time.
Got it. Yeah.
So it's
they're not
necessarily
like writing a check.
purchase.
Yeah.
Correct. Yeah. So it makes it an easy transition. This is the way that it typically happens in retirement as well. We have options. We do have guardrails on the length of time that you can do sort of an earnout, or there is also more cash up front sort of option. So there is optionality when an advisor goes to retire, but it aligns interest because if you're on a shared revenue share, you're all, including the firm, we're all incentivized to keep the clients happy, have a nice smooth transition. The successor advisors are motivated to take over those clients, grow them. They'll eventually step up to the full revenue share and can then re-monetize that practice again when they retire. So there's a nice continuity, alignment of interest that happens.
Internal transitions solve the succession side of capacity, but the other side, operational capacity, requires serious infrastructure investment. And this is where most firms underinvest because the ROI isn't as immediate. Parallel spent capital on centralized trading, dedicated planning teams, tax specialists, service pods with built-in redundancy. These aren't nice to haves. They're what enables advisors to actually focus on client relationships and business development instead of rebalancing accounts and operational tasks. The question worth asking is, how many firms have both the capital and the discipline to build this level of infrastructure before they absolutely need it?
But back to your original question about creating bandwidth, I think part of it is this. It's these structures that we have in place, but it's also about resources. It's about, the technology that we have that's very efficient, and we can go deeper into that, but we have a very strong DNA in technology. In fact, Jake, my first partner, had a background in technology before he got into wealth management and was at a wirehouse, and then him and I teamed up. In fact, when we started the firm, Salesforce was kind of a startup, so we partnered with them and helped build some of the products. And Jake has spoken at Dreamforce a couple times too, because he made friends with those guys. So the tools are not, it's an important piece of the offering. And then it's the resources. If advisors adopt the firm strategies, which, again, there's plenty of autonomy there. They're not forced to. But if they do, we have centralized trading, so they don't have to rebalance their accounts. We have a full planning team, so if they don't want to do the planning themselves, they can engage the planning team to engage the client. Again, creating bandwidth. So leveraging firm resources is a really good way, I would say tools and resources is a really good way for advisors to just have more time to focus on the high value added relationship pieces with clients and or going to get new clients.
Right. The financial planning team, the investment committee, the trading desk, the tax team, all things that they otherwise would have been needing to figure out on their own. So that's a big driver of capacity. Yeah.
That's right.
And I think too, one other thing on that too, to touch on is that we haven't really focused on a lot, but just our service model in general, right? That each of our advisors has the opportunity, right? We've got an incredible service team. And so we have them divvied up into pods, but each one of the advisor's clients has a one-to-one relationship with an operations person. And we use operations as a pretty broad-based term, but they're almost more of a relationship manager. So they can handle any, they're not there to give advice, but they're there to handle any, basic tasks that an advisor needs them to handle. And so it's a true white glove service for our clients on the back end. So that's why a lot of times, our advisors that have moved over have been incredibly successful because they've truly been able to say, hey, Mr. and Mrs. Client, I'm making this move to parallel for you as much as for me, because, the service has been terrible at XYZ, or it's been, on the way down. Now I get to really elevate that game to where it needs to be and where it should be. And we're going to keep going from there. And I think that's really important.
Can you explain those pods in a little bit more detail? I was tracking, but I'm not sure I totally tracked.
Yeah. So we've got, we call them, I think they're divvied up by gems or colors, teams of 3 to 5 operations people that obviously work with multiple advisors. And so that way they can be cross-trained, et cetera. But then each end client works with one of those individuals on a one-to-one basis.
Got it.
Does that make sense?
And there's redundancy there. So the reason we have pods is if one of the client service associates, which we call operations team members, if they want to take a vacation or if they're out sick, there's backup there, with the rest of their pod. And the pod is familiar with the same clients.
Infrastructure creates capacity, but capacity alone doesn't drive growth. You still need advisors who are actually activating it. And this is where many platforms fall short. They build the resources, then wonder why advisors aren't using them to grow. Parallel built something else. Peer-driven accountability structures that create motivation without management pressure. Because advisors, sometimes they resist being managed, but they'll absolutely respond to peer expectations. The forum model Jake's about to describe isn't new. It's built upon an established YPO format. But how Parallel operationalized it for organic growth, that's worth paying attention to.
This was CJ's idea, and it's a great one, and I think it works well. Forums are, obviously we have all advisor meetings where we bring people together and talk at it as a large group. But at a large group level, you can't get into some of the nitty gritty stuff that you want to get into. And so breaking it up into forums allows small groups of advisors, usually no more than 6 or 7 in one group. And as the chief wealth officer, I participate in all the forums, so I can share ideas across forums. But the goal is to get that group of people together, and it does a lot of things. Number one, it gives the ability for advisors to make connections with other advisors they might not normally come across in their day-to-day. I would also note that the forums are not static, so they change on a year-over-year basis. So you're getting a different cohort every year. And then it gives you the ability to obviously dive into details that are more relevant for your group. And so each forum has the ability to decide what it is they sort of touch on a regular basis and come up with their own agendas. And again, it's my role to bring in thoughts or best practices from other areas or from the firm at large to communicate things that are going on at the firm. But what we see is that people really are able to hone in on either a specific case study or a thing that's working for them or challenging questions they're getting from clients or any of those components that are important in the day-to-day of running clients on a regular basis. And so I think the challenge or the opportunity from my standpoint is that we make that the most effective use of our time as a group. And so I want people to come in ready to talk, participate in the conversation, that we're touching on topics that are relevant, that get them engaged and excited about showing up for that hour conversation. And then usually there's some follow-ups after the fact, and some of that falls on me, some of that's the other advisors continuing to talk to each other. But each forum can decide, hey, is once a month enough, or should we meet twice a month? And so different forums take different approaches depending on what they see as valuable.
So these different advisor forums, you've heard, Meg, the study groups in the industry. These are sort of internal study groups at Parallel. That's what it is. And so the accountability piece that Tony's talking about is really almost like a self-accountability. As an advisor, I would be part of this forum. At the beginning of the year, I'd say, hey, teammates, here's what I'm going to do this year. Here's how many clients I'm going to get. Here's how active I'm going to be. Here's my strategy. And then, they check in once a month with each other to see how things are going. And if things are going well, everybody wants to know, well, what's going on? If things aren't going so well, I want to ask my peers and my colleagues, hey, what are you doing that's working? Or, hey, I'm kind of stuck here. What advice can you give me? So they're really a nice, again, it's a fabric of our culture, but it's a nice information sharing, a nice best practices sharing that I think advisors really appreciate because, again, having been an advisor for 20 plus years, it can be a lonely business, unless you're sharing with teammates.
I don't think you can understate the value of those advisor forums. And in fact, you being in it, you might not even know like the true power. Are you in YPO or EO, CJ? Is that where you got the concept from?
Yeah, so I kind of borrowed this from YPO, let's say. I was in YPO. I'm a little bit over 50 now, so you do term out at age 50. You're no longer considered, young by YPO's, young president's organization. But yes, I was in YPO for 6 or 7 years. And we had these forums groups there that worked very well. And so we kind of borrowed that concept to implement it parallel.
I'm an EO, and so I've been in my forum for 6 years, and that's why I know how powerful these forums can be, because it's the comfort, the confidence, the motivation, the inspiration that you can get from your peers is so incredibly important. And to your points, all of your points, to be able to just in real time, at minimum on a monthly basis, to be able to hear about what's working, what's not working, to have a group of peers who are holding you accountable. I mean, it really sort of creates what I think many people sometimes long for from like the good old Wirehouse days, right? Like when it was like the 10, 20 years ago, when it was the conferences and like they had that culture of feeling like they were really part of something and part of a team. The RIA community has been a little bit slow to catch up to how to build that. You're already there. It sounds like you're sort of a leader in that space. So I think that this forum concept is really, really important. And I just know even from our experience at FICOM, so beyond my experience as, in EO and in a forum, we have a cohort-based marketing coaching program that we offer through enterprises like Parallel. And we max out our cohorts at 12 advisors. We can run multiple cohorts for our business at the same time, but we cap it at 12 because that's really where we know it's so much about the special relationships that people develop within their cohorts. It's that experience sharing. It's that understanding of what you've committed to doing and being able to support each individual advisor, that there is something magical about sort of keeping it small and intimate. Are you looking to supercharge the growth journey at your business? FICOM is ready to make it happen by serving as your embedded growth partner. Let us put our unmatched industry and growth marketing expertise to work for your business. Our strategy-first, multidisciplinary approach ensures your business goals stay at the forefront, so you're always aligning all your marketing activity around the growth you want to achieve. Visit us at ficompartners.com to find out more. Peer-to-peer accountability enables something that top-down structures just can't. Creating the space for independence and judgment builds advisor trust in an organization. Advice from your peers feels much more relevant because you know the person you're talking to is experiencing the same thing on a daily basis. Parallel seems to be a leader in this space in a really exciting way. You mentioned to me earlier that we had discussed, I think originally it was that advisors' growth comes most often from client referrals, CRI referrals, marketing activity, and also the custodial referral program. And then you mentioned that Parallel also has a solicitor program. So can you talk to me a little bit about what that is?
Sure. So, yes, historically at Parallel, advisors have generated most of their lead gen efforts. And we found that to be the most effective way to continue to get fill the top of the funnel from an organic growth side. There are other things that we put in place over the years as we've talked and gotten feedback and thought about it internally. Obviously, participating in the custodial referral programs is one. Another angle is a solicitor's program, which allows you to more formally put a relationship in place with a COI, whether it's an estate attorney, a CPA, a business consultant, or those types of things that help people buy and sell businesses. And so that we formalized that process where those people can get compensation in a similar manner that we compensate custodial referral programs. And so we vet those people. It's just not a come one, come all type approach. We put them through a process. We have to be very comfortable with that referral source, and there's a contract that's signed and all of those types of things. But at the end of the day, that becomes a channel for the advisor to develop as one more arm of their marketing strategy. And so we think that will be continue to be a very good avenue for future referrals.
Yeah. I heard you say, and my ears perked up a little bit, that advisors have been mostly responsible for their lead gen efforts. And I'm quite interested in that because I think if you look across the industry, there's this feeling that there's a feeling from executives at RIA firms that they have to be the ones at like a corporate level, that they need to be driving the lead gen. And there's a number of reasons I think that that's happening. I think one is that many firms who are acquiring advisors, they will hang out as a big differentiator. Like, we will help you grow faster here than you could have grown on your own. And so then they think about needing to be able to offer lead gen as a component of that. And I think there's another train of thought, which is advisor productivity, and recognizing that if advisors could just be with more clients more often, that growth would follow. And so there's like sort of a productivity piece, but there are trade-offs there's trade-offs to thinking about corporate driven lead gen versus what you focus on at Parallel, which is really empowering the advisors to own their lead gen. And so talk to me a little bit about the trade-off. Like, it's a different economic model. It's a different relationship when you've got corporate driven lead gen versus self-generated leads. Yeah.
Well, I think everybody would say that there's not one size fits all here, and that nobody uses one strategy exclusively. So, but certainly we've always leaned heavily on advisors to go chase down their own leads. But I think what's important is the economic conversation in the background, and not a lot of people talk about this. But when you think about the firm investing an enormous amount of resources in order to create a consistent lead gen engine, at least for us, because of our payout structures and how high they are, there's a give and take there, right? So if the firm is going to develop a large engine, spend a lot of time and effort on it, dedicate people and asset money and resources to developing this engine, then naturally there's going to be a haircut on the economic side. At least that's the way we view it. And so, like any other program, custodial programs are similar. There's a haircut on the profitability of those clients because of that you're getting those leads sourced for you. And so we think that's a natural extension in a corporate development lead gen effort. And so when you really start to look at those programs, if you're a successful advisor and you're really good at going out and finding your own prospects, the last place you want to go is to a custodial referral program or another program that takes some sort of haircut off the top. And so I'm not saying it's a bad thing. It's a good thing. We should develop it. We should have that capability in place. I think we've got some work to do there for sure to make that program successful. But at the end of the day, as an advisor with my advisor hat on, if I can just go self-source leads on my own, it's going to be a much better relationship, more profitable relationship for the firm and for myself ultimately. And so that's the way we've sort of, that's the construct we're operating in today.
Now, everything we've heard so far has been about what's working exceptionally well at Parallel, but I want to dig into what hasn't worked, because the experiments that fail often reveal more about a firm's strategy than the ones that succeed. Corporate lead generation is the promised land everyone is chasing right now. Firms are investing millions to build these engines, and Parallel tried it and it didn't work. And their honesty about why it failed and what they chose to do instead is some of the most valuable analysis you'll hear about organic growth strategy. One of the conversations that I'm having more frequently in the industry with teams like yours is it feels to me like there's a certain pressure that is existing at larger RIAs to drive corporate lead gen. So corporate generated qualified leads that are then distributed to, the field of advisors. And so there's a lot of work happening to try to build those engines. In a former episode that I recorded with Mission Wealth, I spoke with John Werns, who was formerly the chief marketing officer at Wealth Enhancement Group and probably one of the, I think, brightest marketing minds in our industry. And he and I were sort of joking around about how there's really less than 20 firms today, maybe not even 20, that are doing that type of corporate driven digital lead generation well and profitably for a number of reasons. It's hard, it's costly, it requires a different structure, and most firms have skipped over the foundational elements that are required for those programs to be successful. Do you feel that pressure? I mean, is that a conversation that's happened that you've discussed at Parallel?
So I'll take this one. So I believe so. Advisors are constantly asking for this, right? So this is something that is not new, or this is something that I think we've heard from pretty much close to day one, that advisors have asked for. How can I get leads? Like you mentioned, it is a very difficult thing to do, and going back to what has made our advisors successful to date, it's more about the culture, the resources, the economics, because we can support and having the services that they can go out and talk to clients about. Our advisors have been very successful in just generating self-sourced referrals, and I feel like whenever I'm on panels talking about growth, and people ask me, CJ, why is Parallel growing so rapidly? They're expecting a silver bullet answer. It's this one thing that we're doing, Meg. And really it's not. It's the hundreds of things that we do at Parallel. I wish we could do it for our advisors, but at the end of the day, I've been an advisor. The advisor needs to be active. They need to be the one, driving the business. We have tried a few different things to try and support lead gen, and we haven't found the right formula yet to have it be successful. We are going to continue trying, but at the end of the day, it's not an easy endeavor, and it is costly, and there needs to be proper training. And at the end of the day, if advisors are successful getting referrals on their own, they're probably more likely to continue doing that versus giving up some sort of compensation to offset the cost of a lead gen program. So our plan A is to support advisors to go out there and do it themselves. We're going to continue to, do plan B, work on plan B, but it is costly. So, there needs to be some sort of offset from a profitability standpoint to have that be successful. We've benchmarked our compensation heavily. It's something that we do every year to make sure that we're sort of a top payer in the industry, not just for advisors, but across the board. And, that's one of the things that we do pay very well. I think our advisors enjoy a very nice compensation framework. And, because of that, if we have to, for profitability reasons, invest heavily in an area like digital lead gen, we can't afford as a firm to pay the same levels of compensation to advisors. So that's kind of the trade-off. The other thing I'll say too is that there are firms out there offering higher levels of compensation. And my retort to that is, for any advisor that's talking to one of those firms, is ask for a P&L statement. Let's see if that's a profitable firm, because, being at this now for almost 20 years, I know where, and compensation to advisors is one of the biggest expense, the cost of goods sold, one of the biggest expense items at the firm. And so there's only so much that you can do to run a profitable firm. Just to, give you a real story. I mean, we piloted a digital lead gen program a couple of years ago, and we were able to get a lot of leads. We basically chose 4 counties here around the Bay Area. And we were doing, targeted, zip code and demographic, marketing to get leads off of social media. And what we found is we got a lot of leads, to your point earlier. But the advisors, the team that we had on that weren't able to convert those leads to clients. And that's kind of where it failed. And we still have that program. I think at some point we're going to revisit it, but I do think it requires a different model where you've got a very highly skilled sales team. Yeah. So you're almost bifurcating sales from advice.
Yep.
So that I believe it can happen. It is costly, but I believe, it can be successful.
It can.
What I would prefer is invest in culture, invest in resources, invest in economics for advisors, support them to do their own lead gen, because they are warm leads, they are referrals. That's where we've had success in the past. But not all advisors are, driven. They don't have the skill set to be sales or don't like it. So we have a structure at Parallel where they can partner with other advisors that maybe are good at that skill. And the servicing advisor, is good at that skill, so we can we have teams at Parallel that can kind of complement different skill sets between advisors, which I think is a really powerful model as well.
The economic trade-off of corporate lead gen is under-discussed. It certainly is a fork in the road when it comes to a firm's values on budget. It's difficult to pay top compensation, invest in resources, and fund corporate lead gen while staying profitable. Something has to give. Parallel chose advisor activation. So up until this point, we've talked about lever one, organic growth through activated advisors. Now let's look at lever two, inorganic growth through M&A and recruitment. And here's where Parallel's model gets even more interesting. Most firms treat M&A and recruitment as completely different channels, different economics, different prospects, different outcomes. But Parallel built something that blurs that line. Their dual equity structure means advisors can choose when to monetize rather than how much to monetize. Mike Murray runs firm development, and what you're about to hear is how M&A is starting to look a lot like recruitment.
I mean, I think at the end of the day, the reason Parallel has been successful in growing is because, number one, we try to just create and keep a great culture going. I mean, I think culture is a really important component of why advisors would want to stay or work at a certain firm. So culture is important. Resources, make sure that we have the appropriate offering for clients, the efficient technology to support the advisors, client service associates, operations team members. There's a lot of personnel that's involved in sort of providing resources for clients and for advisors. And then thirdly, it's economics and how do you compensate advisors? Do you offer them equity? Those types of things. So even though the advisors have a significant amount of autonomy, I would say at Parallel. And by the way, I was an advisor for 20 years, and we can, talk about Immigrant Bank and Carl Heckenberg. And when we did that deal, he basically forced the issue and said, CJ, you can be CEO or you can be an advisor, but you can't be both.
Can't be both.
So I ended up giving up all my clients, which was the right thing to do, by the way. But I was an advisor for 20 years, so I appreciated the level of autonomy and enough room there for each advisor to use their own style and work with each client as best for that client, because every client's a little bit different. And so there needs to be a level of autonomy. However, you also want to have advisors, the philosophy be very similar. So the financial planning process is very similar across the board. The investment process is very similar to asset allocation. The way that we pull in different teams, there's centralized resources for the advisors with our investment committee, with our financial planning team. We have a tax group. So even though there is a level of autonomy there, and advisors do operate somewhat independently and they can partner together if they want, there is a sort of this consistent foundation underneath all of it that they can leverage to provide a pretty similar experience to clients across the board.
But the story, right, of who we are as a firm doesn't change. Right, in terms of the firm that they're joining and what that all looks like. And oftentimes we've found that we've, sat down in conversations where somebody says, I'm done. I need to sell my firm. Okay, great. Let's have a conversation and see what that looks like. But then you dig a little deeper and you realize they're just frustrated with running their own business, and they're wearing 10 different hats, and they're dealing with all of this non-revenue generating activity. And you realize if you can clear the decks for them and get them back to why they became an advisor in the first place, which is, helping their existing clients, getting new clients, they get re-energized and excited. And as we go through the conversations, there's actually been multiple instances of advisors that came to us thinking M&A and actually joined us under what we call our partnership model, advisor recruiting. Just because they saw they had the timeline. I mean, hey, if you've got 5+ years, it makes a lot more economic sense to come under the advisor recruiting model. There's the opportunity there for growth within your practice and within Parallel. It's going to be much more beneficial to the
let me build on that point too, Meg, just so that it's super crisp, but just to build on what Mike said. So whether it's M&A or recruiting, I think the reason advisors are attracted to Parallel are, number one, for culture, number two, for the resources that we provide, and third, for the economics, which I think our model is a little unique, or at least not very common out in the industry. So whether it's recruiting or M&A, those are the things that sort of attract advisors. Advisors then have the choice of either monetizing their business on the way into Parallel through M&A, the traditional structures that you hear out there, or they can partner with the firm And like Mike was describing, at the end of their career, when they want to retire, they can monetize, the practice that they built, and obviously monetize equity in the firm as well. So you kind of have the choice, do you want the money up front or do you want the money on the back end? But either way, and we have both of those are available, but either way, the reason people join Parallel are for those three things I mentioned, for culture, resources, and economics.
Got it. I think that those two paths is kind of cool that you've got that optionality. And I was thinking in my head, my assumption was when you said, when we were talking about advisor recruitment, I was thinking like young, fresh out of college, like wanted to ask like, how's that going? What does that look like? Are you getting career changers? Now I understand that it's probably a similar to your point, Mike, like they come in thinking M&A, but then they end up thinking, oh, actually, because of my time horizon, this makes a lot more sense for me to go this recruitment path. So that's when you say advisor recruitment, it's really about, you've got sort of a profile of advisor that's going to be a great fit at Parallel. They want to be a part of a team. They want a firm who's going to help them eliminate the stuff that they don't want to spend their time doing so that they can focus on what they do best. That's going to help them grow, Tony, through you and your team's valuable resources. But that they're hardworking, right? They're, rowing hard in the same direction. They're not coming to sort of, right off into the sunset. So I feel like you've got a profile, right, of an advisor team that you're looking for, Mike. And then the difference between M&A and recruitment is just what makes the most sense for where they are, what their needs are.
Exactly right.
Yeah.
Exactly.
Yeah. And one clarification too, Meg. We're also talking like our biggest channel, our biggest opportunity is actually advisors that own their own small firms that want to partner with Parallel and offload the compliance, the operations, all the stuff that advisors don't like to do and really shouldn't be doing to grow their business. So it's not just teams and recruits, at wirehouses and banks or other RIAs. It's literally our strongest channel is advisors that own their own firms that now want to, link onto a fast growing firm like ours that provides resources to help them grow.
What Mike just described reveals something most firms miss. Advisors thinking about M&A are often just burned out on operations, not actually ready to exit. Clear the operational burden and they'll stay for another decade. But the dual equity structure Parallel built, this is the mechanism that makes both paths economically viable. Because most platforms offer advisors one or the other. Sell now through M&A or build equity for later through recruiting. Parallel offers both simultaneously. Let's hear Mike explain how this works.
Yeah. So when advisors come on board to Parallel, obviously they get a very, competitive revenue share of the revenue that they produce at the firm. They're also able to retain equity in their practice, as well as they get equity in Parallel itself. So, and we do have transition capital available as well, right? So you take that pull through line, fast forward, hey, you join now, fast forward 10 years from now, you're getting ready to retire. You've now grown your practice that maybe was, 100 million when you joined and $1 million in revenue. You've now grown that to 3 million in revenue, 300 million in assets. You have the opportunity internally here at Parallel to monetize that practice, and you have the ability to choose your successor advisors and what that's going to look like, right? So there's that piece of equity. Then you have equity in the firm itself. And obviously we're a very fast growing firm, right? So not all equity is created equal. So, personally, right, I wanted to take a bet on a firm that's, when I joined, it was at 5 billion. Now we're at 10, right? We're just hitting the hockey stick of growth. I think a lot of advisors see that we have the foundation of any of the firms, that are larger than us, but we have this room now to really grow and experience and reward ourselves with that equity in Parallel as well. So that's where I think we're pretty different, Meg, and just in terms of that dual equity strategy.
So that's the economic structure, two paths, same destination. Now let's talk about who this model attracts, because the profile isn't what you might expect. Parallel isn't recruiting 25-year-olds fresh out of CFP programs. They're targeting established advisors and teams, people managing anywhere from 100 million to over $1 billion in assets. That's a very specific universe. Mike breaks it into 3 buckets.
We really have 3 different buckets that we look at, Meg. So, the one bucket would be your traditional breakaways, right? Advisors coming from wires and banks. Obviously, what does that profile look like? Generally speaking, that's going to be a single advisor or, a smaller team of advisors, kind of up to, I'd say, five advisors is usually what it looks like there. Then to CJ's point, you have that RIA owners that realize they should not be running a business anymore. And they want to get back to doing what they got into this business for, which is helping clients. And then the third bucket is RIA advisors, that are at maybe one of the mega RIAs and they don't have equity in their practice. They don't have equity in the firm, right? So those are the three buckets that we're really recruiting from, or, pursuing M&A opportunities on. And, it's anywhere, to CJ's point, he touched on it, a single advisor up to, a team. I have a call tomorrow afternoon with a team that's 11 advisors on the East Coast. So a lot of different variations in there. But anywhere from, 100 million in AUM up to $1 billion in AUM, I would think would be our sweet spot. But we've also talked to, firms that have more than that, and we can certainly handle that and absorb that as well.
3 buckets ranging from 100 million to over $1 billion. If Mike hits his 2026 goal, they'll bring on 12 to 18 new partners this year alone. That's aggressive growth. And this is where culture stops being a nice to have and becomes your primary filter. Because at that pace of integration, one bad cultural fit can poison multiple advisor forums, disrupt service pods, and undermine the peer accountability system they've built. So when firms talk about culture and M&A, what they're really asking is, how do you scale intimacy? How do you maintain the fabric when you're adding this many new threads? Let's hear how Parallel thinks about this. I know that I have heard that your culture is very, very strong and quite differentiated. And culture is this squishy thing that no one really knows, what is culture and how do you define culture? I think of culture as it's a feeling that you leave people with or that people have when they're experiencing you, your team, and your business. How would you help me understand the Parallel Advisors culture?
That's a very good question. And I'm going to hand it off to Mike and how we present that, because we get that question quite often when we're going through the recruiting process with advisor partners, potential advisor partners. And it is a squishy thing. And so we do recommend that they visit the office. But let me hand it out to Mike, because I think Mike Murray describes this, sort of in the best way when we're talking to candidates.
Yeah, no, thanks, CJ. And feel free to jump in and augment my response as well, obviously. But Meg, I think, and that's really what attracted me to the firm, to be clear, was the culture, right? So I've been in the business over 25 years now, on the IBD side, on the RIA side. And when I came to visit and sat down with CJ about 3 years ago now as well, to your point, it was that feeling that you get when you walk in and you see, as you walk down the hallway, that people are happy and they're excited to be here. And I finally then had the opportunity to where my home office was actually in my proverbial backyard here in San Francisco, and couldn't be more excited about the opportunity to come to a firm that had already been growing, extremely well, and then allow me to build out my team to put proverbial gasoline onto the fire to really ignite that growth and take it, to new places. And so when we sit down with advisors, it's really all about them, obviously, right? And just asking the questions, hey, what are you looking for? Why are you looking to make a change? Obviously. And so, if they start to bring up certain things, hey, I'm on an island. I don't feel like I'm a part of anything, right? And that's what I think CJ has done an amazing job of building Parallel to where we are all connected. We all do put on the Parallel jersey. We're all in the same boat, rowing in the same direction, really hard together. And so, advisors have the opportunity to be equity owners in the firm. They still retain equity in their business, right? So we have a very unique dual equity strategy that not a lot of other firms have. And so it's just that pull through line of where advisors, they get an advisor liaison who's a peer on the way in.
We have a saying around here, if I can carry a briefcase into a meeting to add value to a client, I'm happy to do it, right? And so building these networks of relationships is important for keeping culture, headed in the right direction. There are other things that we do there. We have, in addition to advisor forums, we have peer mentor relationships where, as a new advisor joining the firm, you get paired up with somebody that's been at the firm for a long time. And then in addition to that, we have an internal advisor chat thread where you can just fire questions into it and you get answers immediately from other advisors, right? And so it's a broad range of topics that come through that advisor thread, but those are the things that everybody's struggling with on a day-to-day basis. And when you can get an answer in 2 seconds instead of trying to, spin your own wheels and come up with your own solution, it just does a great amount of, it makes us all, a little bit better. It allows us to have one-on-one conversations to dive deeper into a topic. And so there's a lot of frameworks we have in place to continue to drive culture, and it's all related to that forum experience.
Yeah, I'm glad these guys, jumped in with sort of more stories, because I was going to give you words, Meg, like transparent, collaborative, enough room for autonomy, yet, we have centralized, probably what a lot of firms tell you. But I do think that culture is a very difficult thing to describe on a podcast or a Zoom. You really do need to come into an office, meet the people, meet a bunch of the, high caliber folks that we have at Parallel, because the thing I'm most proud of is just the quality and the caliber of people that we have here. Over the years, that's the thing that I get sort of the most jazzed about.
Notice what they didn't say. They didn't talk about mission statements or core values posted on walls. They talked about equity structures, forums, collaboration, and feedback loops. That's culture as operational design, not aspiration. And CJ's about to make this even more explicit, because Parallel's culture isn't built on what they think advisors should want. It's built on what advisors actually respond to. 3 specific things. Understanding this framework is what enables everything else: the forums, the autonomy, the revenue share model, even why peer accountability works when management pressure doesn't.
There's one thing I know from having been an advisor and then obviously, running Parallel, is advisors do not like to have a boss. Now they will accept, sort of peer camaraderie. And this is why I think really it's our job to facilitate these things, part of our job, because back to what motivates an advisor. And I learned this framework a long time ago, but the 3 things out of this framework that I learned and I really appreciated as an advisor is, number 1, a level of autonomy is important. Number 2, relationships. And so this is what part of the advisor forums, why we did it, but also how do we help advisors create stronger relationships with their clients? And this is through tools and resources, so relationships are really important to advisors, most advisors. I'm not going to, stereotype everybody. And then economics, and this is why we're on a payout model or a revenue share model, because you have unlimited earning capacity or potential as an advisor at Parallel. The sky's the limit. You want to work harder, you will make more money. So we really sort of embrace that. And there's pros and cons to that. And but really those 3 things, autonomy, relationships, and sort of economics are near and dear to most advisors' hearts. They were to mine. And so those are the things that we're trying to promote here at Parallel.
Autonomy, relationships, economics. That framework explains the structure of everything at Parallel, including how they approach something most advisors resist: sales accountability. Because here's the challenge. Advisors want autonomy, but growth requires activity. Most firms solve this with top-down mandates and activity quotas. Parallel built something different. The gamified sales system CJ's about to describe is his management consulting DNA showing up. But what makes it work isn't the technology, it's that advisors are measuring themselves against their own goals, not being measured by management.
That piece as well is one of the resources that we have at Parallel is, we've almost gamified the sales process for advisors so they can measure their own activity. They have a sales goal in Salesforce. We've built this and we have this sort of defined activity point system that gets you to a new client. And so you can set your own goals. You can measure your own activity points. What's real activity and not real activity. But you do have to be, what you just said, consistent, diligent about it. You have to measure it. That's really what, in my opinion, sales is. And that was the part of the business as an advisor that I really liked. I really liked meeting new people, obviously delighting my clients and serving them very well. And then they would introduce me to another person. And I loved going out there and seeing how I could possibly help that person be in a better situation that they are today.
I see some of your Accenture management consulting background coming through in the gamification of your sales pipeline. I love it. I have one more question for you, CJ, and then I'll wrap us up with our final question. I know that recently Parallel Advisors formed a trust company, and you've talked on this call about the importance of breadth and depth of resources, and that resources, in addition to culture and economics, it's one of the 3 pillars of what makes Parallel so special for advisors. So that's lever 2, inorganic growth through both M&A and recruitment, enabled by dual equity, 3 recruiting buckets, and capital partnership to build institutional grade resources, which brings us to lever 3, market performance. And CJ's philosophy here is worth noting because it's the opposite of what most firms lead with. No proprietary strategy, no claims of alpha generation, just disciplined market capture.
We're just trying to capture market performance. We're not trying to outperform the market. We're just trying to, intelligently, in a risk intelligent way, capture the returns so that we do get some growth over time.
3 levers: organic growth, inorganic growth, market performance. Never all firing at once, but that's the point. You don't need perfect alignment of outcomes. You need multiple engines ready to capitalize on whatever is working. Organic growth through activated advisors, inorganic growth through dual equity paths, market performance through disciplined capture, all built on understanding advisor psychology, autonomy, relationships, economics. So what comes next? I asked the Parallel team what they're building toward.
What I think most excited about is the opportunity. I work with an incredible team, and just they've now been here and gotten to really understand the Parallel story. And so now I feel like we finally have that opportunity to really get out into the marketplace and continue to just expand our net and just capture even more incredible advisors. I mean, this year alone, we're probably going to bring on 10 additional partners. And next year would love that number to be closer to 12 to 18, really good partners to join the firm. So that's what I'm really excited about.
And so for me, looking at the next 5 years, when you look at us as a firm, Barron's put us at 64 on the top 100 list. I feel like we've got a lot of the things in place that the peer group in that top 1%, that are further down the list than us, they have the same things that we have. And so, trust, family office, tax, I feel like we've got all of the things in place that we need to continue to grow this firm. And we just need to continue to execute on those in a really fundamental, deliberate way so that our clients are happy. They refer us more clients. And for me, weirdly, that's what I'm excited about. It took a long time to get where we've gotten, but I feel today that we're really hitting on all cylinders, and we've got a really good approach to the future. And for me, that's exciting. So not have to worry, we've got to go build a trust company. We've done it. We're not going to wake up tomorrow and start an investment bank. We've got all of the things we need to really drive this firm forward. And so from my standpoint, I'm excited just to execute on what we built today. And I kind of have to pick my head up every now and then and look around. I think we all do, because we're working so hard on a daily basis that it's sort of a surprise for somebody like you to say we've got something special, because we're just in it on a day-to-day basis and we're not focused too much on what's going on around us.
Is there one recent tool or technology that you've rolled out that you're feeling really excited about?
I mean, there's a lot that I think that we're working on. The fun one that I'm sure everybody talks about is AI. We've been addicted to Claude coding for the past couple of months and building apps on our spare time, and it's amazing what you can do. If people aren't paying attention to this, it's such a step change for the industry that it's hard to put it in focus. It's hard to even realize it even now that we've been doing this for so long. We have a lot of tools that incorporate AI that we sort of purchase off the shelf, but being able to look at your own business processes and create custom tools for yourself, even if they're just tiny little point solutions for one aspect of your business, has already saved us hundreds of hours of time. And I have a list that's probably 15 deep of tools that we want to build. that we'll roll out internally. And there'll be little agents that just sit there and do this one thing. But the ability to do that on our own, code it in the weekend, deploy it, test it, run it, and launch it live is phenomenal.
So that's a peek into 2026 for Parallel. Continue to deliver on the fundamentals, lean into AI, and bring in more of the right partners. 2 decades on from when he founded Parallel Advisors, I asked CJ to zoom out and tell us what he hopes for the next 20 years to come.
So I'm 55, so I'll be 75 in 20 years, just for the record. But I think the industry will change a lot between now and then. However, I do think that firms are continue, to get bigger and scale. And that's one of the things, I said the $100 billion number, our next flag in the ground. I think that's totally doable. There'll be $1 trillion, RIAs, many of them $1 trillion RIAs plus. The industry is going to continue to grow, in my opinion. AI is not going to replace advisors, in my opinion. So I'm excited to just continued growth. And what I love about it is as we grow, it creates an ecosystem where everybody at Parallel can find a career path and a role that they're excited to do every day. And that's been the most rewarding thing for me about growth is the bigger that we've gotten, the more opportunities there are for all of our professionals, our advisors for sure, but also all of our folks that are not advisors at Parallel. And so, 20 years from now, I expect Parallel to be a much, much bigger, entity with a lot more resources and a lot more technology because AI is, going to be a useful tool. So I'm very curious to see the evolution over 20 years. I mean, 20 years is a long time. I'm thinking 5 years there's going to be a lot of change in this industry. 20 years is kind of
what's your timeline for the 100 billion? What's your timeline for the 100 billion? Do you have one yet?
Well, firms double, if we can continue to grow at the 20 plus, growth rates, what is the rule of 72? So we can probably double every 3 years, so, I'd say within a 5 to 7 year time frame is probably a pretty reasonable, goal to set. It wasn't that long ago that we were 1 billion and it took us a long time to get there. So, and it wasn't that long ago that we were 5 billion. So I think the opportunity is out there. And again, we need great partners to help us do it because we need more people at Parallel, to be on the journey.
You know what strikes me most about this conversation? There was no secret sauce, no proprietary algorithm, no revolutionary strategy that changed everything overnight. Just hundreds of things done well. Forums borrowed from YPO that created peer accountability. Internal transitions that freed up capacity. Dual equity structures that gave advisors optionality. Service pods that built redundancy. Revenue sharing that offered unlimited upside. Gamified sales systems that created self-accountability. Marketing budgets allocated directly to advisors. Operational decisions that compound over time. And here's what's liberating about this approach. You don't need all 3 levers firing at once. In fact, they never do. That's normal. That's expected. You build all 3 and eventually 1 or 2 work each year. That's enough. Because the advisors you're building for don't want a boss because they will accept peers. They want autonomy, but autonomy built on real infrastructure that actually works. Internal transitions, centralized trading, planning teams, tax teams, service pods, not marketing language, real systems. What makes this conversation valuable is the honesty, the willingness to say what didn't work, like the Bay Area lead gen experiment, the transparency about economic trade-offs, the truth about running a profitable firm at scale. 9 years to hit the first billion, then acceleration. Not because they discovered some silver bullet, but because hundreds of operational decisions compounded over time. So if you're waiting for the one big idea that will transform your practice, here's what I want you to hear. There is no secret. There are just hundreds of things to do well and the patience to keep doing them. That's the lesson. That's growth. Did you like this episode? What were some of your key takeaways? I'd love to hear what resonated with you from today's conversation. Find me on LinkedIn and please share what you loved or leave us a review. Ratings and reviews really are always appreciated. At FICOM Partners, we're on a mission to help advisory firms achieve the growth you're capable of. We serve as your outsourced CMO and marketing department, driving marketing-enabled organic growth through strategy, execution, and advisor coaching. For more valuable growth resources, visit ficompartners.com/insights. Please subscribe to the podcast and on YouTube so you can continue learning from other inspiring growth journeys. I'd like to thank today's guests, our producers at Podpony, production assistant Molly Spina, and my ever so remarkable executive assistant, Kristen George. This is Meg Carpenter, CEO and co-founder of FICOM Partners and your host of The Growth Leaders of Wealth Management.